Hello and welcome to another episode of the Real Estate Investing Club. I'm your host, Gabe Peterson, and this is the place investors go to gain actionable advice, learn about current market trends, and hear war stories from other professional investors out there in the field today. Before we get started, I have two quick housekeeping items for you. First, if you like this episode, we would very much appreciate a like, subscribe, and share. It is the best way to support the show and keep it running far into the future. Second, if you're a new investor looking to get started in real estate or an experienced investor looking to take your investing to the next level, I've created an ebook just for you that will cover how to find deals that are actually deals, how to finance those deals with little to no money down, and how to exit those deals for maximum value. On top of that, I throw in an insane amount of free bonuses that you'll have access to once you buy the ebook. All I charge is our admin costs to keep this show running. So if you're serious about real estate investing and want to create both active and passive income as an investor, head on over to the website at therealestateinvestingclub.com and click on the button that says get the ebook in the upper right-hand corner to grab yourself a copy. With that said, let's dive right in. Today we have a very special guest with us, ready to drop some investor knowledge on you. So buckle up, grab your pen and paper, and enjoy the ride.
All right. Welcome back to another episode of the Real Estate Investing Club. Today we have Rob Beardsley with us. Rob oversees acquisitions at Lone Star Capital Group and has written a book called The Definitive Guide to Underwriting Multifamily Acquisitions. So guess what our theme is going to be today? It's going to be about underwriting. I'm super excited because this is one of the most important steps in closing any commercial real estate transaction. Well, I mean, residential too. So underwriting is super important, which is why I'm super excited to have Rob with us today. Rob, thank you very much for hopping on.
Excited to be here.
All right. I told you before we got on here, we always start with stories at the Real Estate Investing Club. So I'm sure you got a good one. Why don't you take us to yours? How did you get started in real estate?
So I got started in real estate, kind of had a little bit of a real estate background coming from my family's business on the West Coast. My parents ran a residential brokerage firm, buying and selling luxury real estate for their clients. And then on the side, they did some flips and developments. But the problem was they never really built wealth. Everything was about the next deal. It was about, getting that flip done or selling that next house. Mm-hmm. And so I saw that as a broken paradigm. I saw them stress and struggle, and that was not what I wanted for myself. Right. Certainly was taught at a young age to work hard, to excel, to build things. But what I saw was just a slightly different vision, which is to actually build wealth and build wealth that endures and grows. And kind of that was a big part of my kind of the way I saw things growing up. And then the other
paradigm shift.
Yeah. The paradigm. And then the other thing I saw was, or the other thing that I really felt starting at a young age was delayed gratification. And I know you could definitely understand this, and every investor understands this. It's the whole point of investing. It's, I'm going to forego the bird in the hand because I'm going to hope to get two in the bush at a later time. And so that's what investing is all about. And that's what we're here for, is to actually delay gratification to get something better in the future. So I've always been about delayed gratification, right? Work hard today, enjoy tomorrow. And so starting in my journey in real estate was really in college. When I was studying computer science, I was kind of circling back and thinking about, well, how am I going to invest my capital? Let's just say I do make a startup successful and I make a bunch of money. What am I going to do with the money? And so I was thinking, well, I'd probably invest it in real estate. And then I thought, well, how would I do that? And so I just started studying and reading, and kind of like everybody else's journey with podcasts and books, and then with the added upside of being able to go back to my parents and ask them questions and get their opinion. And so that's what led me to Multifamily, which is the focus of our company now, which has a great balance of both cash flow, but also appreciation. So it's a good balance of being able to, eat and enjoy some of your investment today, but then also build for a better future tomorrow. So yeah, that's kind of the short story of how I got to where I am now.
Cool, man. I love it. So you grew up in real estate. I've said this so many times, but I'm always jealous of people who kind of, grew up in the environment of real estate. Cause, there's a lot that you just kind of learn just by being around people who are doing who are actively involved in real estate. So you had your mom and dad, they were in luxury real estate, but you saw they were just doing the transactional side. They weren't actually, building something that took care of them for the long run. So you wanted to do something more like multifamily, which is cool to hear. And there's nothing wrong with transactional real estate for all you agents out there. I mean, I love the art of the deal, as good old Trump says. I love doing deals like that. So there's nothing wrong with that, and you can make good money on it. But Rob, I'm totally with you. You want to find something that kind of gives you a little bit of a road to walk on without you having to go out there and make the money. So cool. You got started there, and then you got in the multifamily. Obviously, so many people love that as an asset class. It's very stable and has great cash flow, as you mentioned. Your specialty in, there's a million things you can do in real estate. When you're talking about taking down large multifamily assets, there are countless roles in that. It's not just one person, doing everything. Your specialty, it sounds like, is acquisitions. So why don't we talk a little bit more about that? You wrote the book on underwriting, and that is one of the most important things when you actually, you make the money when you buy the deal, you make the money on the close. And so you got to make sure that you're actually closing on a good deal. So why don't you take us to underwriting? What is your guys' underwriting process?
Yeah, sure. So for those that are not familiar, underwriting is just simply the process of taking in financial information. And in our case, it would be the seller's financials, their profit and loss statement, their rent roll, and then any other kind of due diligence that we need to be able to put together a pro forma and make projections about our future investment. And so we need to take in price, revenue, expenses, future growth assumptions, capital expenditures, if we're going to do major renovations and things like that. So all that needs to be taken into account into an underwriting to then develop a projection about the future and projected returns. Obviously, that's what we're here for is returns. And so the way that underwriting keeps you safe is obviously by identifying risk and avoiding deals that don't project a high enough return for you based on that risk, and then filtering out the deals that make sense, or filtering to only the deals that make sense. So that's a high level description of underwriting. Now, our process is we look at, I'd say, over 1,000 deals per year, but we only underwrite maybe about 500 of them. And so we're churning through deals constantly. And with every deal that we underwrite, we are going through that full process of, inputting all the financials, making projections of the future, using rent comps and sales comps data to inform our assumptions. And obviously our boots on the ground and our portfolio knowledge and experience also helps us inform our projections as well. And then with all that factored in, we basically solve for a price for that asset that would give us the returns that we're looking for. So if we say that, okay, well, for this type of deal, we want a 14% IRR and let's say average cash flows of 8.5%. And so we'll just find the price and we'll just tweak the price to get us to those numbers. And then we'll submit that as an offer or just feedback it to the broker and say, okay, so we, if in order for us to hit our numbers, we need that price of 20 million. And then they'll laugh at us and say, oh, sorry, we've got offers for 25. And then we move on to the next. So that's an iterative process that we do hundreds of times per year. And that allows us to filter down to doing maybe the best 5 deals that we see all year, which, can keep us busy and successful.
I like it. So you start with 1,000 and then you just kind of eyeball it to figure out the ones that you actually do want to spend the time to underwrite. And once you choose that 500 that actually do want to underwrite, you go through the entire process front to back. I want to dive a little bit deeper into it, but first question. So I've spoken with some very successful investors, on the mobile home park and self-storage side with, thousands of units under contract. And it seems that what surprised me was that they said that IRR is kind of a bullshit metric to use in terms of deciding on a return. They like to use cash on cash return, but everything that I've heard prior to, getting into real estate was said, everything that I read said to use IRR. So what is, in terms of deciding the return that you guys are getting, how do you decide what return you want? And then what metric do you use to measure that?
Yeah, so these are really great topics. So I would wholeheartedly disagree about the IRR. I think IRR is a little controversial because it is complicated and it's easier to manipulate than cash on cash. So people that have been manipulated or just they know the powers of it, right? They might want to kind of walk away from it. But the reality is, if I only had one metric to use for the rest of my life, it would have to be IRR because it's all encompassing and it's the most robust. Cash on cash, it just ignores all the potential value that you are creating that you would realize through the future sale, right? Cash on cash just speaks to how much cash flow you're actually making. So, and different deals have different profiles. So some deals you might buy and they have great cash flow, but really no capital appreciation, no future upside. Conversely, you might buy a deal that's half vacant and it's a lease up play, it's a renovation play, and you're actually able to double the property's value, but there's no cash on cash along the way because you bought it half vacant. There's no existing income. So neither on their own is sufficient. So to answer your question, as far as the metrics that we look for, okay, well, actually, before I talk about that, what I will offer up as a solution for those that are leery of IRR, I would say that yield on cost is just the best. That is, if you want something that's hard to manipulate, maybe even, very difficult to manipulate and highly informative, then yield on cost is that one. It's the best
And
one. And the reason
for everybody, just explain what your yield on cost is.
Yeah. So yield on cost is there's a couple different ways to calculate it, but kind of the holy grail way would be an untrended, stabilized yield on cost. And what that means is when you are looking to buy a property, you would kind of through your calculations, figure out what you think is the projected or stabilized NOI, net operating income, once you have completed your business plan. And since it's untrended, you actually don't forecast growth. So even if you're in a super hot market like Dallas, Phoenix, et cetera, you're not going to bake in another 10%, 20% of rent growth that we've been seeing happen, right? You do it untrended. And that would be your NOI. And then you would divide that by your cost basis, which would be your not only just your purchase price, but also your CapEx, because we have to factor in the cost that it takes for you to actually achieve that stabilized NOI through your business plan. And that's going to give you kind of like a cap rate on steroids, a much more informative cap rate, and will give you the true return potential of that property. And the key there is you have to have an awareness or knowledge of the market to be able to know what a good yield on cost is. Because if I told you, oh, the yield on cost in this deal is 6, that might be amazing or it might be horrible because it's all relative to what the market is trading at. So for example, in primary markets in Texas, stabilized cap rates are around, I would say, 4.5%, which is crazy, but that's what they are.
And
so
you're talking about 4.5%. That's a pretty good asset because I'm buying a self-storage down there for a 12 cap right now. And so,
perfect example.
Just to clarify, 4.5%, that's for a stabilized, quality, B or A asset.
Correct. So okay. If you, you bring up a really good point, because if you're talking about a 12 cap for self-storage, then a yield on cost that would be considered good for there would be completely different, right? You would want 13, 14. The key is that you want your yield on cost to be greater than the market cap rate, because if you can't make it to be greater, then you actually didn't create any value. The market values your stream of cash flows at a lower multiple than what it's costed you to build. It's kind of a weird way to think about it, but that's the name of the game. We want to create value by building a stream of cash flows for less than what the market for what the market can buy it for, because then they pay you more. So that's kind of the idea. If it doesn't really matter what the number is, as long as it's more. And so typically you want to see 50 basis points more, 100 basis points more for bigger risks. So for example, if the market cap rate's 5, then if you can get a yield on cost of 6, then you're going to, with that, when you introduce leverage, you'll be able to get mid-teens returns. And that's what many people are looking for. So yield on cost, that's the one. So we look at yield on cost, absolutely. But then obviously the real estate is heavily reliant upon financing, and we can't just look at numbers on an unlevered basis. And that's what yield on cost is. So we have to introduce leverage, and then that's where we can get our cash on cash numbers and our IRR. So for us, we look at both IRR and cash on cash, and we kind of figure out a price that satisfies both, right? We're not going to do a deal just because one of those metrics is satisfied, but the other isn't. And so these days, and I think I forget who you were mentioning as far as those successful investors, but these days it is, I would say, easier to make the numbers work on an IRR basis than cash on cash. So often for the deals that we're looking at, the constraining price factor is cash on cash, because we look at average cash on cash throughout the hold period. We also look at year one cash on cash, and we also look at amortized cash on cash, because when our interest only period expires, when we're only making debt payments just on interest and not principal and interest, cash on cash is easier to have to be higher, obviously. But then once you're making that full debt payment of principal and interest, we want to make sure that our cash on cash is still reasonable, somewhere around 5% at the minimum, depending on the asset type. So those are our return hurdles. So I'm sorry I'm stealing the mic so much, but
no, this is good. Underwriting, especially when it comes to deciding whether to go forward with a deal, is one of the most stressful periods in an investor's life, and also the one that's really hard to master. So I just kind of want to summarize what you were saying. You said the two metrics that you use to decide whether you're going to move forward: IRR, cash on cash. But you think IRR is a more all-encompassing metric, and it's the one that you would choose to make your decision on. What are you guys looking for in terms of IRR? What is the number that you look for in order to decide whether to move forward?
Yeah. So this is a whole other side of underwriting that is far less talked about, right? When people talk about good conservative underwriting, they're always talking about, well, what rent growth are you using, and what exit cap rate are you using, and how are you coming up with your performer rents, right? And those are all extremely important. But then you could get all that right, but if you solve for the wrong return hurdles, then you could be overpaying, or you could be taking more risk than what you actually want to be. So yeah, so on the other side of the underwriting equation is you need to have robust data and models to inform you as to where the market is, so that you are solving for the right return hurdles. And so for us, our return hurdle ranges from 13% net IRR to investor, I'd say, up to maybe 18%. And so why is there a range? It's because of risk. We can't treat all deals equally, right? If we're buying a Class A, beautiful, stabilized deal, there's nothing to do. That carries a lower risk than buying a Class C property where we have to evict everybody. We have to, spend $20K a unit in renovations. There's down units. We have to use bridge financing.
And not only risk, I mean, you got to add money for the risk, but also just for the effort. I mean, having to flip an entire property that you need to evict half of the people, there's just a lot more effort that goes into it than something that's nice A class. So you got to pay yourself for the effort that you put into this. Sorry, I jumped in there. Keep going.
No, you're absolutely right. And that's a lot of people, especially the do-it-yourselfers, do not account for that, right? They might look at a deal and say, the returns look great. Well, yeah, but it might cost you 2 years of your life, and you're going to have to, risk getting stabbed on the property. And there's all this headache that you're going to be living through. If you actually valued your time and your effort into that underwriting appropriately, then you'd be like, this is a bad deal. Because, let's say you were just going to pay yourself a hypothetical salary of 250K or something like that, right? That might offset the numbers in the deal. So yeah, you're absolutely right. You definitely want to factor that in, especially for people who are kind of doing it on their own, where it is all their own sweat and money. So yeah, so our IRR range is about 13 to 18%, 13 for the nicest deals, 18 for the heavier stuff. And then on the cash on cash side, it's around, I would say, would like to see a minimum of 8%. And so we do target deals that have better cash flow than others. We're not buying the brand new A class stuff. Typically, we're typically buying B and C class deals, which do have better cash flows because you're able to buy at a better cap rate. And so we are able to get average cash on cash of 8% and push them near to double digits. So that's what we're looking for as well. And like I mentioned earlier, when the interest only period rolls off, we want to be at 5% minimum amortized cash flow. We never want to be clipping a coupon less than 5%. Also, of course, the goal is when that interest only period does expire, or prior to it expiring, we want to arrange some sort of capital event, whether it be a refi or a sale, to avoid that. We always want to be maximizing cash flow and returns. And so that's one of the ways that we look to do that.
Yep, absolutely. I'm glad you said that because there is such a hype about the BRRRR method in single family. Everybody was like, you got to BRRRR the single family. And I like to remind people that you can BRRRR anything. You can BRRRR a commercial property. You gotta think about the refi when you get into it, because the refi you can take out so much equity. So I'm glad you brought that one up. So you do the underwriting, you know your metrics, you got your IRR, your cash on cash, but it doesn't, that at this point you have found the property. So let's take a step back. Let's go into a little bit. How do you actually find the properties? That's one of the more difficult things. Once you find it, that's half of the battle right there. So what is your guys' acquisition kind of process in terms of sourcing the properties themselves?
So I am both proud and embarrassed to say that we have never bought a property through a traditional marketing process. We have never gone through a full marketing process, a best and final, and then have been awarded the deal. We have never closed a property that way, which is very embarrassing because we've underwritten thousands of deals and we've been through many best and finals. And I can't wait to be able to actually do that. But for whatever reason, and just due to the competitive nature of the market, all the deals that we've done have either been some combination of off market or a broken transaction. So property might have fell out of contract or it never went under contract. And, we call that a stale marketing process. So the key is hanging around the hoop for us. That's where we've been the most successful is off market and hanging around the hoop. And I wish I could tell you that we were more slick than that even, and that we were, we had an army of people cold calling a bunch of owners and, but we don't. 95% of our deal flow.
Yeah, that's the beauty of acquisitions is that there are so many ways to do it and they all work. Hanging around the hoop, that's the first time. I like the phrase. It's the first time I've heard about that, but it makes a lot of sense. You're just kind of waiting for those properties. They always, I don't know what the metric is, probably 2 out of 10 properties fall out of contract once they're under. And so you guys are just waiting for those gems to hit the ground and then you pick them up.
Yeah. And it's all about the broker relationships. It's all about making yourself known as, hey, I'm a buyer at this price and I know this market, and they trust you as a closer. So we're hyper vigilant about a reputation, and it's not easy to build a good reputation. And you might jump on a podcast and talk about, well, we never retrade and we always close on time and all these amazing things, but when the rubber meets the road, actually doing all of that is very challenging. And we're not perfect, but that's very important to us.
Yep, absolutely. Yeah, I mean, I'm actually going through a transaction right now where I've had to extend twice, and it's just like, oh man, I feel so bad for the seller, but thanks, man. I'm telling you, I love you guys, and you just drive me crazy sometimes. All right, moving on. We are just check the clock. We are through our original time frame, so we got to move into the quick question round. Are you ready?
I'm ready.
Okay, starts with books because I'm a big bookie, but you can interchange books with podcasts, with TV shows, whatever you want. Give me 2 recommendations: one for general life wisdom and one for real estate specific.
So for general life wisdom, I would say I'd like to pick one out that's a little under the radar, but nothing's coming to mind except The Power of Now. That's a good a little bit woo-woo, but that's good.
No,
and I'm big on meditation and kind of being present to the moment, as difficult as it is these days.
Yep.
And then as far as real estate, I would say, obviously, putting aside my book, we would have to go with a similar book to mine in that it was kind of written by an industry veteran, and he did it under a pseudonym, undercover. It's called Investing in Real Estate Private Equity, by Sean Cook. That's the name he used for that book. And that's a really good book for learning about deal structures, partnership structures. And it's written actually for the investor side of things, but it's very great to read, whether you're an active or a passive investor. And I'm actually striving to write my second book, kind of similar, to have some of those topics as well, about partnerships, raising debt and equity, and things like that.
Perfect. I love it. And I'm a huge fan of The Power Now too. Eckhart Tolle is a great writer. And I'm going to you didn't list your own book, but I'm going to list you just because, You got to shout you out there. So you wrote The Definitive Guide to Underwriting Multifamily Acquisitions. Sounds like something every investor needs to know about. So where can they go and pick that up if they want to reach out?
Yeah, so my book's available on Amazon in both Kindle and paperback. So I highly recommend everybody check it out. It is a short but very powerful read. You can read it. You can read through it in one sitting or two sittings and kind of absorb a lot of general knowledge. Or if you want to sit down and use it as a tutorial, you could actually kind of follow it step by step as you kind of go through an underwriting process with it. So it's kind of a manual, if you will.
Perfect. I love it. All right, moving on. And this one is for your younger self. So if you could go back to the Rob who had no experience in real estate, I guess you always had experience because you grew up in a real estate family, but back to the Rob who had no active experience in real estate, go to him, look him in the eye, give him one piece of advice and move him forward.
I would say some of the good advice out there is the best deal that you do is the one you don't do, right? No good deal is better than avoiding the bad one, right? Avoiding the bad one, especially early on, is really valuable, although it could teach some good lessons. So I would say that's a great one. And relationships, I think that's just a cliche, but that's so important.
Perfect. I love it. Relationships, and don't be afraid to back out of a deal if it doesn't turn out to be what you expected it to be. Great advice. All right, moving on. This one is habits. Habits are the foundation of our life. So if you could pick one thing that you do every single day, day in and day out, that you feel contributes the most to your overall health, well-being, happiness, and success, what would that one thing be?
That's a tough one. That health, well-being, happiness, all that stuff. What I was going to say when you kind of teased the question earlier, kind of about, because I thought it was going to be more about success, I would say journaling and writing down my goals daily. That has been really cool and very effective. Actually putting your goals down on paper, especially goals that you don't really know how you're going to achieve, and then looking back on them and seeing that you actually got there, right? The path shows itself. And just the act of writing down, ruminating, looking at it, the more time you spend with your goals, the more likely they are to happen. So I've been a big fan of gratitude journaling and goal writing. So I'd say those have been very great for life and being kind of how do I say it, like definitive about actually getting the life that you want, right? We kind of say, oh, we want to be happy, we want to be this and that, but okay, what does that actually mean to you? What is happiness to you? What is success to you? And so getting more clear about the outcome, it makes it a whole lot easier to get there.
Yep, absolutely. I'm a huge fan of journaling, and I like the idea of just write down your goal every single day. It's amazing if you just write it down day in and day out. It gets into your subconscious. It gets pounded down in there, and actions come out of the things that are written in your subconscious. So great habit. Moving on. This one is the last question, and it's for the listeners because you've given us a lot of good things to think about. I'm sure people out there want to reach out, say hi. What is the best way for them to do that?
So I'm, as far as social media, I'm very active on LinkedIn. So I'd love for everyone to join me on their post daily real estate stuff and personal stuff on LinkedIn, on YouTube as well. But if you want to get in touch with me, you should head over to our website, which is lscre.com. On our website, there's a free giveaway for my underwriting model, which is a standalone Excel spreadsheet that you can use to analyze property. You could also buy my book and then kind of use them hand in hand. And then feel free to reach out to me directly through our website as well.
Perfect. That is lscre.com. Don't want to screw that one up. lscre.com. I will put that in the show notes. So if anybody out there wants to reach out to Rob and say hi, just click the little more in the description. It'll pull down the full description in there. You can find Rob's website. Reach out and say hi. So Rob, again, thank you very much. It's been a pleasure having you on.
I enjoyed the conversation. Thanks.
Yep. And for everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. Other than that, I hope you guys have an absolutely fantastic week. Keep rocking real estate, and I look forward to seeing you on the next episode.
Thank you for joining us for another episode of the Real Estate Investing Club. I hope you guys enjoyed the episode as much as I enjoyed putting it on, and we're able to pull some actionable advice that you can apply in your own investing today in the field. Before you go, we have a gift for you. If you're a new investor looking to get started or an established investor looking to take your investing to the next level, I've created an ebook just for you, available on our website. This ebook will cover how I was able to create both active and passive income in real estate with very little money to start with. In it, I will address the 3 most often cited obstacles new and veteran investors run into by showing you how to find deals that are actually deals, how to finance a deal with little to no money down, and how to exit those deals for maximum value. And if you get the ebook today, I am throwing in a bundle of bonuses, 7 of them to be exact. The first one will be the off-market lead generation blueprint, which will take you through the exact systems and processes we use to generate off-market leads like clockwork, which is the most important skill when it comes to creating wealth in real estate. The second bonus is the A to Z REI systems and vendors guide, which will allow you to peek under the hood of our business and see the exact tools, systems, and even the vendors we use to see the success that we do. And the third bonus is the top 100 best performing keywords pack, which will give you the exact keywords we use to target motivated sellers online using PPC ads. The fourth bonus is our contracts bundle for wholesaling and renting real estate, which will give you access to all the contracts we use in the field to execute all different types of transactions. After that is the Investors Quick Analysis Calculator and Offer Tool, which will allow you to quickly calculate whether a deal is an actual deal and will allow you to create an offer automatically from those calculations. This is a lot of bonuses that I said. I'm just going to keep going down the list. Number 6 is the Investors Daily Success Tracker, which is a tracker you can use to ensure you are taking the right actions day in and day out to reach your financial goals in real estate. And the last bonus is the Wholesalers Template for Quick Assignment Cash, which will give you the templates we use to present our wholesale deals professionally and efficiently to our buyers. Whew, that is a bundle. So it's a mouthful. You get all of those bonuses for free when you download the ebook. All we charge is the admin cost to run the show. So if you're interested in the ebook and the bonus bundle, head on over to the website at therealestateinvestingclub.com. Click on Get the Ebook Bundle at the top of the page to take advantage of that deal. And with that said, I hope you have a fantastic day, an even better week. Keep rocking real estate, and I look forward to seeing you on the next episode.